All right, this is Ken Long from Tortoise Capital with the weekly online swing trading workshop presentation and lecture. So the place to find the each of the weekly recordings, if you go to the Swing Trading Online Workshop, is go to the YouTube links. Right board. And I've been posting them here under the weekly webinar transcripts. And then some of the lessons that I have extracted, I've placed lower and included in some of the weeklies down here. So, but this is where I have been posting them. So last week's is probably needs to be looked at a couple times because it has the that extended discussion of the regression line fractal framework and then also the squeeze. So that's one that I would look at and study carefully. Let me see. Get started. Okay, so all right, so here's the agenda for today. We'll look at, first we'll start with the preview of next week's homework. So the ones for this week were the RLCO case studies, the coaching and mentoring, and the weekend report. I added just today the weekend report for this weekend. That's posted at YouTube, and the link for the executive summary is already on the lineup for, I think it was for this week or next week, for the March 13th. The videos for the week ahead. These are conceptual ones. So frame-based trading really talks about the structure of trading, setting up your frames and it looks basically where the blue line is my standard for starting the stalking. So I put that in blue. And I should say that if this was yesterday's candle, and we're talking about daily charts now. So if that was yesterday's candle, and maybe there was a signal that fired, it could have been a 5-day down in a row. It could have been a triple screen that was up and it pulled back and gave us a 2-to-1. Is going to give us a 2-to-1 reward to risk ratio. Or it could have been that 551W. It could have been channeling or overreaction or anything. Essentially, it comes down to, or maybe it was the auto framer, and all we care about is the trade location. The trade frame always starts with yesterday's candle. And then these other ones, the signal that gets generated really just pertains to the previous pattern, and then it tells you something about how that particular pattern has performed over time. But anymore with the trade framing, if we're looking just at trade location, the idea of trade framing is that we can study trading opportunities simply on the basis of where the trade is located, and not care as much about the particular pattern. So we get a lot wider choices. Now, this is especially useful if you're going to use a standard method of computing reward and risk for your swing trades like I do, and then maybe using that to qualify the trades in terms of goodness, and so that you could prefer to take trades with a higher reward to risk ratio compared to other ones. Or inside a particular system, if you had 10 things that fired on 5-day down and you wanted to just concentrate on the best ones, you might decide to use a standard calculation of reward to risk to have a basis for choosing one thing or another. Well, that's where this idea of the auto framer developed, and you'll get a chance to see that in the videos this week when we talk about auto framing. And it's really kind of the same as frame-based trading. Tom asked me, given the choice between a non-pattern symbol with a high reward to risk ratio and a pattern signal with a lower, how do I choose? I choose higher reward to risk all the time, because all I'm trying to do is reduce risk in order to generate bigger payoffs. And so that one takes more priority for me than belief in a particular pattern. So that would be my tiebreaker. And I'm satisfied with that decision approach. So the first thing I draw then, if this was the range yesterday, here was yesterday's candle, and whether or not that was filled in or not, it doesn't matter. So the first thing I draw is that blue line that indicates that I'm stalking it. See, in this period before that, I'm watching it, and now when there's a reason to be interested in it and be ready to frame it, that's when I go to that next level of stalking it. So the first thing I do is draw the vertical blue line to get on high alert. The second thing I do is, if I'm going long, is I draw the risk level, and that is the price at which I know that this hypothesis to go long has failed. So I do that before I do anything else. The second thing that I do, or actually the third thing that I do now, is the purple line, which I will go up to the 10-day high and draw out the reward. Okay, so I'm drawing my reward. And then what I know is if I insist on a 2-to-1 reward to risk ratio, I can now compute what the maximum price that I can pay for this thing is and still have a 2-to-1 reward to risk. So maybe it's like this, 2 to 1, and maybe that, and not drawn to scale, but maybe it's 2 to 1 that looks like that. So where I really want to enter is 5 cents above the high of day -1. So we're going to say this is the preferred, we're going to call that the ME, or the mechanical entry, M.E. Now you can get the mechanical entry if it opens inside yesterday's range. So if tomorrow, so on this one it closed right here. So if the next day there's a little gap down and then starts taking off, you can actually get the mechanical entry. What you have to be concerned with on the swing trades is what happens if it opens above my mechanical entry. Maybe it opens up in here. By computing what the 2-to-1 reward to risk ratio is, you know what the maximum price is that you can pay at the entry and still have a 2-to-1 reward to risk ratio, and that assumes that you're still using the mechanical risk of 5 cents below day -1's low. So when people ask me how do I handle the gap, that's how I handle the gap. There are some of the rule sets that say you must have an orderly entry, and that is it has to open inside yesterday's candle or inside yesterday's range. So any gap outside of yesterday's range invalidates that setup. So that has to be part of your trading frame for the next day, is whether or not you can, whether or not a gap outside of the range will invalidate the signal or not. But what I will always do is calculate what this, 2 units of, what this 2-to-1 reward to risk ratio is. So if it was $12, so if this was 88, was my mechanical exit, and 100 was the swing high, then I know I have to have $8 and $4 to keep my two. So the most that I can pay for this is 92, and still use this as the reward to risk ratio of 2-to-1. So hopefully it would open inside yesterday's range at 90, and then maybe I get a mechanical entry at 91. If that were the case, I'm only risking $3, and I'm hoping to get 100, so there's 9. That actually gives me a 3-to-1 reward to risk ratio. So if it gapped above 91, but not more than 92, I would be entitled to take that trade because I still have 2-to-1. The size of my position would be smaller because the $3 per share risk allows me to have 133 shares if I'm risking $400 the way I normally do it. Whereas if I was risking $4 per share, I could only have 100 shares. In both cases, I'm only risking $400. But the position size is a function of the dollars per share that I have to pay to see that the hypothesis was invalidated. So that's an essential point. So that's what I mean, generally speaking, by trade framing. And that's what this frame-based trading technique is going to talk about. How to use a structured approach to engineering your reward to risk and entries in order to establish a scaffolding. So I almost end up having like, this discretionary box. If that was yesterday's price, there's sort of a max that I can pay and a minimum I can pay. So I can have some discretion inside this zone, but I cannot buy it above here, and I can't short it below there unless I'm using some other system. And that's what the frame-based trading means for day trading. Now, it may be that intraday there's things that I can do, like if I had something that was 5 days down, or a washout, it was really horrible, and then it gapped down below yesterday's low. So here was the trade frame. I want to go long here with a stop here, but it gapped down below and now is selling off, and it's selling off harsher than the market. There's things that I can do intraday as a day trader that get me into that situation, so I haven't lost the value of that trade frame. What my swing trading frame did was tell me that this thing that was horrible is now in an exceptional condition of selling, that it now becomes a high priority for shorting intraday. So I can use my swing trade frame as a way to develop other actions that make sense, that are consistent with my belief system. Everybody clear on that? Well, if it's not clear, just go ahead and let me know. So that's what I mean by frame-based trading. So now let's think about when you see this movie on the ready, fire, aim technique. This is a very flexible way to apply the insights from frame-based trading into ready, fire, aim technique. So let's suppose that I have set up a trade frame, and here was yesterday's candle. So, as I said, the very first thing that I should do is draw my vertical blue line. That's what that should have been. Sorry. My mouse is horrible here. I'm going to get a drawing tablet. So I draw my blue line. Sorry, I'm going to redo that. This looks like crap. So here was yesterday's candle. Here's my vertical blue line indicating I'm stalking it. Here's my red line, 5 cents below. That's the price at which my hypothesis to go long is invalidated. Here's my mechanical entry, 5 cents above yesterday's high. That's my mechanical signal to go long. So what you'll see in the green, yellow, red zone technique, those are going to talk about the green zone is the area where I want to go long. The red zone is below that red line, places where I want to go short. And it treats yesterday's range as a yellow zone, a discretionary zone where I have no new information about which direction the swing trade trend is evolving. So I don't know if it's starting to resume that move north, which is what I want for a swing, or if it's failing big time, which is what I want for a swing trade to the south side. There we go. So inside this yellow zone, I have some discretion. So let's say that this thing opens exactly at the 50-yard line. Now, when you read the and listen to the green and yellow zone trading, it will talk about this idea with ready, fire, aim technique. And that is, I'm ready to trade this. I'm ready to trade it if long here and short there. And then inside this yellow zone, I can only trade if I can see a 2-to-1 reward to risk ratio using the green line as my upper limit and the red line as my lower limit. So if it opens right at the 50-yard line, I don't have a 2-to-1 reward to risk ratio. But let's suppose this thing started to sell off and starts to stall, and now we are maybe 90 minutes into the session, and it hasn't violated the red line, and now it starts to give me some morning hook action. There are some intraday techniques that I can use to start trading this pattern. If I saw this, and if I know that my intraday, if I know that my intraday risk using day trading techniques is a box that big, and if there are 3 of those boxes intraday, so maybe a third of yesterday's range at a minimum. We have other ways to compute this, but this is sort of the rough version of this idea. That if it sold off from the open, didn't violate the red line and started to hook up, maybe it comes across this 1/3 line, and now I have 1 unit of risk, and I'm going to do this. I'm going to take this as my intraday risk box, so I have 1 unit of risk that I've identified, and maybe that's 50 cents. Because my standard unit of risk per trade is $400, if I'm willing to take 50 cents risk on this, I could conceivably have 800 shares intraday. As long as I don't take more than a 50-cent risk, my 800 shares only represent $400 of open risk. And then I have plenty of reason to believe that it could get to yesterday's high. Once it crosses this threshold, if I buy it right here, I have reason to believe it can give me 2 units of reward, because yesterday, that's what it did. It got as high as that yesterday. So my hypothesis is, yes, it could do that today. So now what I can do is, if I have 800 shares intraday and it makes 2 units of reward, this is what that core and turbo looks like. This is what ready, fire, aim technique leads you to do, is that I'm ready to buy it up here, but now I've already got 2R in hand, and I've made $800, and I can use 400 of that 800 and put that in the bank and feed the bulldog. And I can use another $400 and fund this position with overnight level of risk, and off it goes. And then hopefully I see 1, 2, 3 days of reward on a swing trade that has been totally funded by the money that I made intraday using the turbo technique. Well, this same technique can work if I go up a scale, and if I'm swing trading using weekly candles, I might be able to use daily signals to get my initial entries. And so now what I get paid to do is to determine what my minimum manageable unit of risk is, so that I can compute if the trade frame that I see offers me 2 to 1. That's what we mean by ready, fire, aim technique, that I am prepared to trade this according to a certain scaffolding, and then as the day unfolds or the week unfolds, I see price action that allows me to front run that decision and either increase my position size without increasing the dollars at risk, or if I only wanted to risk 50 cents, I might buy that 133 share position, but only have 50 cents at risk. I can actually buy my swing position down here, and I'll still get out if it violates that red line, but now I will have only risked 50 cents instead of $4. I will have reduced my risk by 80% on that initial position, and I still have reasons to believe that if this trade gets through the green line for the daily trade, then it's still going to work. But what happens if I get this entry and then it doesn't get up to the green line and starts to fade? All I have to do is take that trade off intraday and have no overnight risk, and I never take the signal. And that way I may be able to make some money in order to pay off the effort and the time that it takes me to manage this trade intraday. Or if I'm using a weekly and daily framework, to check my positions every day instead of at the end of the week. So the video on ready, fire, aim technique and green, yellow, red trading talks about that. The auto framer goes into a little more refinement about how we use that spreadsheet to actually compute, using the spreadsheet, all of these reward to risk ratios, maximum payments. It also takes a look at using different levels of risk instead of simply using the range risk. And so what I mean by range risk, again, is nothing more than if that was yesterday's candle, and if my mechanical entry is 5 cents above, my mechanical stop is 5 cents below, this is range risk. If this was a very large range, it might be greater than 1 ATR. And maybe I don't need to maybe I don't even need to use the whole range risk. Maybe I can just use 1 ATR instead. Or if this was a very small range, maybe I don't want to use too small of a range. Maybe I should use only a quarter of an ATR. So what you'll see in the auto framer is the way the spreadsheet allows us to look at the spreadsheet lets us look at different levels of risk in order to make a sensible decision on position sizing based on the actual size of the candle. Patrick asked me, do I swing trade positions at $400 as well? I'm using 500 right now because it's a rounder number. I should probably raise that. I could raise that, but I have become comfortable with that by keeping the dollars at risk constant. It gives me a little sense of it's easier to compute the trade-off intraday of how much overnight versus intraday risk I can do. So that's why I've kept it pretty close right now. But the real consideration on that should be a function of how big is your day trading bucket of money versus your swing trading bucket of money. And then how much overnight risk are you taking versus intraday risk? So really what you have to do is figure out your swing portfolio size, the dollars that are in there, and decide what, pick whatever level of risk you want. Is it 0.5% per position? And compare that to your daily portfolio dollars and what your standard unit of risk is going to be. And so once you figure out what your standard unit of risk will be and the percent of your portfolio that you're going to allocate to a swing trade, that will tell you how big your position size is. So maybe on the same instrument, if I was doing it with Alcoa, maybe my overnight risk, and I'm just going to say is $1. Maybe my overnight risk is $1. And maybe my intraday risk is 10 cents. If I'm still going to risk $400 here and $400 there, then I can have 400 shares, and I can have 4,000 shares. And then if I am turboing intraday, what I have to do is sell off 90% of my position intraday in order to carry just the 400 shares I want overnight. Well, that's nice and clean and easy for computing how much you can add or subtract intraday when you're looking to convert day trading to swing trading. But if the size of the dollars, maybe I can afford to have $800 at risk on my swing trade, and now I could have 800 shares versus 4,000 shares, and then I'm selling off 80% of the position. I'm selling off 3,200. So of that 4,000, it's really 3,200 is intraday and 800 is overnight. So as you sort out swing trading one day at a time, or core and turbo trading, or frame-based trading, you have to have these numbers computed ahead of time so that in the heat of the moment when you're making decisions about how much to offload or how much to add, that you're not trying to compute that on the fly. That should already be part of your battle drill. Okay. Yeah, Tom's, $500 are for each position at 4 or 5 positions. Yes. So there is like intraday, in terms of span of control, the most number of positions I can have is 4, so I can use 4 bullets. That's my span of control, 4 open positions at one time with 1 unit of risk on each one. Or I could have 2 positions with 2 units of risk on each one, and then I have put all my chips on the table, if you will. I can't add any more, otherwise my intraday risk is too large. On the swing trade, I may be able to manage 10 or 20 positions, but because the position size is much smaller, I can actually have more positions. What you quickly run into is the issue of overnight leverage versus intraday leverage, and you may be willing to risk more per trade than you have capital in the account to cover the cost of the position. That gets you into currencies and futures pretty quickly, and leverage. But that's the principle. Yeah, Tom, what I like to do as far as pyramiding is that I don't try to get all my capital in intraday or on swing trading all at once. I like to have chips on the table where I can add to positions as they occur, rather than having to say, oh, there's a new symbol, I don't have any money left to put on it, let me go among my positions and then cancel some so I can reallocate the money. So I like to keep some operating capital available, and then that's governed by portfolio heat and whatnot. So when you hear me going through the swing trade positions at the end of the week, on the managing the swing trades, when I talk about dead money and I'm looking at things that are underperforming, those then become candidates for recovering the capital so it can be redeployed somewhere else. Or it may be something where, hey, it had a heck of a move already, and I'm going to tighten up the stop so I can cash in the gain that I was hoping to see, and then just look to redeploy it to the next idea. Yeah, so Facebook was kind of like that, exactly. And there were a couple that occurred this week that we'll see. So that's what I want to say about the the look ahead at these videos are coming up. They're going to be talking about how really to go from systems to strategies. So the strategy is one in which our basic principles of 2-to-1 reward to risk, having a structured trade frame, standardized units of risk and reward. That's really where that ready, fire, aim technique came from, is having all of those techniques and modules available. If I saw something that I could frame out at 2-to-1 and had reasons to believe that thing could go, then I could trade it without having a formal swing system in place that would justify the entry. I still like the systems because it does build in patience and discipline, gives us some expectations about what the trade could actually do on the basis of historical evidence. But as I have become more skilled at trading, I trust my eye to find opportunities to trade, and as long as I can manage the risk and get to no lose plus dinner for two early, then I feel like I'm trading forward using my trader's edge, which is the ability to look for similar patterns or look for opportunities on the basis of trade location and not necessarily on a precise pattern. The challenge on this is that you still have to check your trader quality number, and you cannot restrict it to just mechanical robotic trading. You have to you actually have to take into account what is your judgment over periods of time, good days, bad days, and how you're feeling in order to estimate the quality of your judgment. But I find this to be a manageable way for me to trade, and I use my swing trades now and my structured day trading signals and systems as a way to provide the scaffolding, if you will. So I have these different time frames going forward, and I have different price levels that I've mapped out, and so now I can use these as ways to rapidly estimate 2-to-1 reward to risk ratios. I see price moving like this. I know that when it's down here in the bottom, I can buy it here with this as 1 unit of risk and then 2 units of reward, and then I can quickly determine if that's a trade that I can take and then manage it from there. That's what this strategic approach, or the strategy-based approach, is going to be describing. That seems to me to be a natural extension of gaining proficiency in how the mechanical swing trades work. You don't have to go there. I mean, it's perfectly satisfying to use the systems as briefed and wait for the formal entries and whatnot, and there's good reasons to do that. But this is another way that you can approach the markets. It's a little more flexible and more adaptive. So that's what I want to say about that set of videos and strategies. Though, if you're getting ahead, the ones for March 26th, this has to do with some of that refinement on day one technique, and that is, it talks about how to look at the day of entry or exit. If you want to start fine-tuning your swing trades, that'll start getting into the videos on March that we want to see by March 26th. Okay. So the homework for this weekend, we're to do to identify your high payoff goals and to see if there are any questions about the daily squeeze or the regression line fractal. I want to carry that over. It looked like not everybody could find that video, and it was a pretty complex video. So We're going to roll those two over into March 20th also, so there's still time to add any questions there. And I'm going to trust you to concentrate on your goals. And what I want to make sure is that you add the questions to the whiteboard of things you want to see me cover based on the goals that you've specified and where you feel you are in terms of mastering the material that you want to master, the things that are high priority for you. So let's continue to use that whiteboard. There weren't any questions posted this week that I could see, and so this one is a little bit more free form than going forward. So that's what I want to concentrate on. Now, what I've identified for the homework then for March 20th, I just uploaded a video on a thing I called the curve. It's sort of a philosophical approach to the topics that you're going to see covered in here. It's designed to kind of get you to step back and think of these things conceptually. This is like hot tub hallucinations, if you will. And then again, the other homework would be any questions that come out of the strategy descriptions for the auto framer, green, yellow, red. Get those posted so that I can address them. Okay. So that's what I want to. That was the preview of next week's homework. There were no FAQs that I saw. Other than where could we find the RLFF video, and I showed you that one. Commentary in the message traffic in the work groups. It's still looking really good. I like the crosstalk. It looked like the study groups are of value to you. I would encourage you to maintain the contact after we get outside the course. That's what the community of practice is really structured to do, to find your natural alliances. Insights for the week. I'm going to cover some things that came out of actually my military and my doctoral courses that have some insights into what we're doing. And then I'm going to cover that next. And then I'm going to get into the review of the weekend frames and an update of the swing trade positions. Let's see where we're at here. Just a quick look at where I think we are in terms of the market. Now, the market weekend report is posted. So the S&P right now has come all the way back up to the 200-day moving average. XIV has continued to thrive as volatility is drained out of the market. Brazil and Latin America have been huge. Emerging markets has been excellent. And then this whole cluster over here on XLB, the materials and mining and gold. So Caterpillar, Alcoa, Cliff, 3M, those have all been doing very, very well. The financials have been beaten down the most as a sector, but we're going to see that there's some opportunities developing in Goldman Sachs and JP Morgan that says some of that turnaround might have occurred. And technology, there's some opportunities shaping up in Google and Apple and Facebook that were beaten down and that may be in the early stages of recovery. Yeah, Tom, on for bundle one, send me a separate list of questions on those just directly, because that really involves TradeStation and the TradeStation bundles, and that goes beyond the scope of this workshop. But they're questions that I'd be happy to answer for you. Okay. What you'll see on TradeStation Bundle 1 really is it does most of the work for you on computing the whether or not the signals fire, and then computing the reward to risk ratios, and giving you some management techniques there. Okay. But yeah, send me your questions separately. I did not see the questions. If if you posted them on Friday. I didn't see the, I can go back and look for them. But this is where I think we are in terms of the overall market. And again, if we get the market condition right, we're gonna be in well postured. There were some things I wanted to really highlight though from the weekend report. Now that I'm thinking about it, that I do want to get to, and they're in the video, but I really want to get it to your attention. And I actually want to put it in the, make sure that it gets in the part of the lesson that gets recorded here too. So this has to do with the slope statistic. So when we get into the daily report, so I just blew past the weekend report, right? So now we're looking at the daily, and what I want to concentrate on are these numbers 6 and 7, the market mosaic. So all the usual stuff. And when you look at the curve, the video I give you on the curve, it's going to come back and refer to this little indicator here, the slope of the 30-period regression line. And the slope of that line, the slope value is the moving blue line, and the black line is the 10-period moving average. And now this one, chart 3, is a zoom in of the last 30 days of chart 2. Okay. And chart 1 is the actual regression line itself. So that blue line is the 30-period regression line. It's a straight line that is the best descriptor of these 30 days in the market. Now, that thing is not perfectly flat. If it were perfectly flat, if those 30 days have been, then that slope would be 0, m, which is the slope value, m would equal 0 because it's perfectly horizontal and flat. But you can see that it's not. You can see that it is sloping up at some value, at some arc, in some degrees, right? Call it, whatever alpha, sine of alpha is, or cosine alpha. So the fact that it is a positive slope says that it tells us that the market is going up. Well, there is a point value on today. The slope of that line is a certain value greater than 0. And it turns out that that number is reflected right here. And it's a little steeper up today than it was yesterday. And we know that. The reason we know that is because the line is still going up compared to where it was at each one of those 30-day increments. Because what happens is we drop off a price candle and then we add a price candle. And so tomorrow, if it'll probably go a little bit steeper, a little bit steeper, a little bit steeper. So this blue line here is simply, this blue line on chart number 3 is the line that connects all of the slope values. It's the moving slope. And so now this black line is the 10-period moving average of that line. And so now what we can look at on this chart, on chart number 3 and chart number 2, we'll start with chart number 2. We look back 180 days. And then we find the steepest downward slope and the steepest upward slope. And then we find the average, and then we compute the standard deviation of those point values, and then we mark off plus and minus 1, plus or minus 2, and then we draw the line, and we see this little oscillator. What I want you to notice is a couple things. First of all, this is very adaptive, that because each day we add a new day, and we drop off a day, the average and the boundaries or the size of the standard deviation changes a little bit each day, and so it's constantly adapting to changes in the slope of those curves. So we've got we not only have a smooth indicator, as you can see, we also have an adaptive indicator that changes to longer term market conditions. You can see that it's smooth when you compare it just to chart 4, which is the percentage that S&P is above or below the 200-day moving average. When it's even with the 200-day moving average, it would be right on that dotted line, which is almost where it is right now. But we're about 1% above, so it's slightly above the 200. This also is marked off in units of standard deviation. But because price jumps around quite a bit each day, you notice how noisy that line is. But it generally went down, then up, then down, then up. So when you use a 30-period regression line and then compute the point value of it, of the slope, what you get is a very smooth and yet responsive description of what price is doing. So you get a combination of smoothness and clarity, but you also get adaptivity. And now if you put a 10-period moving average, or a 10-period moving average of the slope line and use that as the buffer, now you can see that it, maybe I'm going to try to zoom in on this a little bit. Now what you get is a very clear indicator. There was this much price improvement at the bottom of the turn, and now once it crossed over its own 10-period moving average, you'll notice that it was 1 and 1.5. So this is 1 plus 0.5. This is 1.5 standard deviations from the zero line. That means this is, so anytime you get this crossover that it was directional this way and then reverses and goes that way, if that crossover occurs more than 1 standard deviation from the zero line, then you have potentially an important change in the intermediate term trend. So now on this chart, what you can see, when we look back 6 months, we can see that there was a turn here, a turning point here, a turning point there. And that corresponded to these changes down in here. And so if we go right from the middle of those circles, by this time we had enough information that the big sell-off had changed its level, and now we could frame it. Now it was going sideways, and now we got an early warning on this potential move. And then here, by this time, this much of a pullback told us that the upward move was no longer the case, and it was much more about a sideways chop. So that we got plenty of warning to guard ourselves against this sell-off. Now, by the same token, this little move, by this time, we had enough information that the big sell-off was over again, and we could start framing trades ready to go north or to go south. And in this case, we got a piece down and a big piece up. So through most of this period, the market was technically in either bull or sideways conditions. Let me show you how I know that. This shows price relative to the 200-day moving average. So in this period that I'm highlighting, this was all bull. This period was all bear because it was more than 2% below the dotted red line. This had bullish qualities here and some sideways. This was bear. And now we're currently in the sideways condition again. So the big market classification was adapting, but the slope of the 30 gives us a much more refined look at what the opportunities are. And if you just think about the last 3 weeks, we have been taking, framing and taking swing trades to the long side that took advantage of this kind of move and produced something like 20R potential, is my rough estimate, out of just the ones that I've been reviewing. And so by having this slope of the 30-period regression line statistic, paying attention to that, you get earlier warning about opportunities that occur in swing trading timeframes. So that's an important insight. The video on the curve that I'd ask you to look at for this week asks you to take a look at this kind of thought process, step back a little bit, and think conceptually about the way you trade or the things you like to trade or techniques that are starting to resonate with you, to ask some fundamental design questions. And it's a little exercise. Should take you anywhere from half an hour to an hour to do, and we'll hopefully put some of this this mini lesson into context for you. Okay, so we're about an hour into this right now. That's everything I wanted to cover from the weekend report. I would like to take about an 8-minute break and then get the trade frames for the swing trades uploaded, and then we'll get on with that. So let me get the online. Where is it? Where is it? There it is. The online countdown. Okay, we're back. All right, so I'm going to go through this little quickly now, just right through the normal stack of things. When you listen to the weekend report and generate your list of things that I mentioned or your swing trade targets, these were the targets that I gathered that I was interested in from a swing trade perspective. And if you listen to that report, you'll hear why I was. And many of these are symbols that we track anyway. There were a couple new ones in there that were big momentum movers, and I'm going to show you how I handled these exceptional ones. Because before, you've seen me frame the ones that are the usual suspects. There's a couple in there like Urban Outfitters and Dollar General and this Columbia Pipeline Group that are new. And so there was an exceptional move that appeared in the blended monthly rebalancing lens. And so I want to show you how I think about trading these exceptional movers after the exceptional move occurred. Okay? Just checking real quick to see if there were any questions that I may not have seen. No, it looks like I answered. I think I answered the questions. Okay, so we're going to start with Apple. So Apple is in the bottom of this this long, ugly cup and handle looking thing, I suppose. You know, we've got this long slope down, and you can see this really in the shape of the dragon if you look at how the dragon has elaborated. But I also want you to notice how this Bollinger Band pinch has occurred. That's one of the ways you know that that downward move is coming to an end. Not only is the dragon flattening out, but the volatility starts compressing again. So that is characteristic of a longer-term change in the state of the market. Meanwhile, that RL270 is still sloping down. You can see that the 30 RL is down, but the river has started to curl up. The 30 has rolled up, and you notice that the 30 has crossed the 90. The 90 has started to roll. The 90 is in that 6 o'clock position, meaning it went like this, and now it's flat. So there's a lot of reasons to believe in Apple as turning the corner here. And since it's a must-own, we can do something with that. So we already have one trade closed in Apple. You can see that we've got the entry and the exit over here. This was one that we raised the stop on it and actually hit during the week, and now I'm going to restock this. So let me zoom in on this a little bit. All right, so the drawings. Yeah. So what we had was we tightened up our stop. This was last Friday, and we tightened up the stop to here because we had gotten the range extension. It went out above Z plus 2, almost to Z plus 3, and I was concerned about it coming back, so we cashed 1 R here. It held 3 times and has now started to roll back up with the doji. Hasn't taken out well, basically, it's back to where we exited from. My concern about taking the profit where I did had to do with the fact that we were still in a sideways market, and Apple was lagging and tech was lagging, and so this exit here was to preserve the potential move all the way back to the Bollinger Band mean, or all the way back to the edge of the river, which was my initial risk. And so we were able to cash an R. So I like that. But now I like this. It held 3 times at the 270. The dragon has now crossed the 270 and is at the north edge of the river. The 10 and the 30 are outside of the river. This is by definition the beginning of trending behavior. Now what that means is, given the opportunity to fail normally it would have come back to here and completed this triangle. That would have been a perfectly rational, normal, explainable move, and that's why I really like cash in 1R right there. Now I have an R's worth of market's money I can work with. So my new trade frame looks like this. Because it failed to fail further, I can now extend the trade frame. This was still the price target from previously. It almost hit that. From this moment here, we were expecting it could get up to there. It did, just about. So that I'm still expecting a little bit of resistance at 104, but the next resistance is up and price target's up here at 109. So I've got 2 units of reward. I'm going to go with a 2-day low or the bottom side of the dragon right here as my risk. So I will go long at the green line. Long at the green line, but I'm also willing to short if it falls through the dragon and the 270, and then my target is going to be back down here to the far side of the river. So I will stop and reverse. If it gets to the bottom of the river and fails below there, I will add a second short position because it will have just made a 30-day low. So that's my trade frame in both directions. Up in here, if it gets north of 109, then I'll look at a second long position. So that's Apple. Any questions on that one? This is, I consider this to be a continuation pattern. If this had been a regular bull market, then this one would have been my natural entry on a universal entry. But because we've been in sideways and tech has been lagging, I wanted to see a little more confirmation, and now I really like the higher low, that they were willing to hold it overnight and over a weekend. Okay, so that's Apple. Amazon. This is a new trade frame. So my blue line is stalking. I'm ready to go long at the green line. That will be a 1, 2, 3 entry. My target is the 270. This is the 90. I will go short if it violates this red line. If it goes below the Bollinger Band mean, then I think it's here, and then my target is down here. So I'm framing Amazon in both directions. If this truly is a place where the market it got as far as it could go and rolls over this, and tech continues to get weak, this is a prime candidate for that. American Express. We just cashed one nice trade on this thing where we got long here, and we raised our stop up to here, and we got an exit in here on Wednesday. Thursday it failed to fail. Friday it failed to fail and gave me a higher low. So now it's retesting that swing high. So now my new trade frame on the doji, excuse me, looks like this. I'll go long at the green line. I will go short at the red line, and then my target is the Bollinger Band mean, and then the far side of the river where I would add a second position. So I'm using a 2-day low rather than just the 1-day doji frame, because I need to see it fail. This would be like from Z2 to Z1, and that would give me a full Z-score for my risk to go short and my risk to go long. Okay? Caterpillar. Caterpillar, we cashed a nice trade that finished up in here. It gave me 1, 2, 3 days down. The bottom of the dragon held, and now we have a 1 and a 2, and now I'm waiting for a 3. So a 3 would be, the 1, 2, 3 entry would be 2 higher lows, and then it takes out the high of candle 2. So I'm willing to go long at the green line. I'm looking at my initial risk being about $1.20, so it's 5 cents below the swing or below the Friday's low, and I would be willing to stop and short at 70, and that's if we saw weakness in all of the metals and mining. And then my initial target to the upside is 75, the purple line. Now, if we look back a little deeper in time, if it can get above 76, this thing is free and clear. So I'm going to pull down one of my green lines, and this is where I would go. I would take a second position long if it can get above 76. So that's what my trade frame looks like there. If you're using free stock charts, having these extra lines already pre-drawn and just staged on your chart makes it a lot easier to frame these trades in practical terms. So you're not always clicking and editing. I just like to do a bunch of them at one time. So CPGX, this is at Columbia Pipeline Group. This one really stuck out as a big winner on the blended monthly rebalancing framework that idea. That's because of that big move on Thursday. And it held that move on Friday, although it did not make a new high. The fact that it didn't make a new high now tells me maybe that's all there is and there ain't no more. And so if it fails below Friday's low, I'm willing to go short at the red line with a target of coming down to test that high at the purple line, and then the secondary target would be the Bollinger Band mean. So I'm willing to go short at the red line or go long at the green line if there's additional value. So this is one of those that I bracket the volatility move that did not fail but did not move out. I now have a one-day channel, and I'm going to go mechanically in either direction. Chevron, been tracking that one along with energy for a while. We got our entry on this one on Monday from the trade frame of the last weekend, and we've had a nice move. The initial target was up here around 98. Yeah, Tom asked me, do I recommend free stock charts? Yes. The system that I'm depicting here, that's the RLCO framework, Tom. It's articulated in there. And you'll see there's a gazillion RLCO trade frames on the YouTube videos, and that they were part of this week's and last week's videos. Well, actually, Robert asked me if I would go through building a trade frame, basically indicator by indicator. I just didn't get a chance to do it this past week, but I will. And I would just tell you that after a while, it's not overwhelming. It's all part of an organic whole. So I will get that done this week. We're on spring break at the college, so I actually have some time. I can't imagine looking at a chart without these ideas now. So the RLCO framework is the document you should read, and then I will talk through how to read that. The combination of Bollinger Bands and the regression lines is really powerful. So, so this is Chevron, and this started off as an RLXD. The regression line came out of this is a pattern 5, a sideways quiet channel in the RLCO framework. Came out of the river. The 10-period regression line and the 30-period came out of the river. So this was the breakout entry on this day on the 4th. And now we've got 5 days up in a row. This is where I am moving my stop to is just below Friday's low. I like that. Friday was a nice day up, but it closed lower than it opened. And so, can we do all the chart indicator? No, it's all in the free version. I'm using the free version. I have the pay version, but I actually like the free version better. I find it easier to work with. So all I'm doing on this one is raising the stop. This is at about 2R in hand, and the energy sector has been good, but it's gotten ahead of itself maybe. It's already up here at Z3. That's the thick red line. So it's 3 standard deviations above the Bollinger Band mean. So I'm going to lock that in at Z plus 2, which is the edge of the river, and 5 cents below. So I'm raising my stop on Chevron. On DuPont, we're still in this one from an entry way back here, and it really hasn't done anything. The stop is down here below the, I actually got to pull it back a little bit to see the stop. Yeah, the stop was back here. So we're about half an hour into this one, and it's just mucking along. I like DuPont because it's in that material sector, and that has been leading the way. We got into this a little late when it left the river, but we're still into it, and I'm just monitoring. If I do anything, in fact, here's what I will do. I'm going to now, I don't want to give all that back, so what I'm going to do is add, that's my initial stop. I'm going to raise my stop to a 2-day low. So now I'm locking in that dinner for 2, so that's about $1.40 per share. Dollar General is a new one. This came out of the weekend report. These 2 days, this giant breakout from the sideways quiet channel is what made Dollar General look so good. Now, the reason I'm interested in this is because you can see this congestion over here was like an all-time high, and it broke above that and did not fail, and they held it over the weekend, and it kept moving out. So I'm going to treat this as a pattern 6, but with a continuation pattern to the upside. So what I've done is I'm going to take, if it gets above Friday's high, I'm going to buy it, but if it falls below Friday's low, I'm going to short it, and then my stop is going to be, or my not my stop, my initial target will be the Bollinger Band mean. So that's my frame on Dollar General. I will follow it, and I will also reverse it. So these are the diamonds. This is the Dow Industrials. I am raising my stop from down here. This is where we got our entry. I'm raising my stop. So let me see if you can see this. We got our entry here, and this was my initial stop down here. I'm now going to raise the stop up to here. It's about $1.50. And our upper limit target is this previous swing high, about 176. So I like that. That will have negated this this gap down, this big gap down. So if it gets up above here, I will add a second position, and then it has to get above about 180 for the all-time high. So I kind of like that one. DIA feels pretty good. Disney, this is one that we framed and entered a while back. We got our entry back here early in March on the 1st. It's really been kind of dead money, but it's resisted, and now it's maybe starting another leg up. And the fact that it made a higher low here compared to this low, I like that. It held above the Bollinger Band mean. So I am prepared to move my stop up below here and start reducing my risk on that one. So that's what I will do. In the Dow, no trade. We're just monitoring that one for Sinal. This is Devon Energy. We got our trade in the yellow box. We got our entry. Then we raised our stop and took an exit here. And then it held on Friday, and the energy sector was up, and it gapped above Thursday's high after a nice bounce off the bottom of the dragon. So I took this entry on Friday when it crossed back above its RL 270, and it closed above the swing high, so I'm really liking this one. I'm going to keep the stop here for now, but my targets are 26.40, 29 even, and I think this one can really go. The whole energy sector is turning, and you can see where these other prices. The next hump of the dragon is at 26. The monthly swing high is here at 29. Then the top of this dragon, the dragon hump at 32.5. There is a huge, complicated transaction right now. Does it make a difference? Not sure what you mean, Robert. Well, I mean, this is a complex moment in the market. I mean, we just had a. Let me go back and show you something on just how significant the moves have been. This is the slopes of the last 10 years, right? Oh, I'm not worried. But Dow and DuPont, that's fine. I'm just playing the patterns. I'm not going to try to micromanage that. If it's too complicated, though, I mean, there's no harm in standing aside. What I want you to notice is that this slope, I meant to cover this, the slope change over the last like 2 to 3 months here. This little spike down was the second worst downward slope in the markets in the last 10 years. That's how bad this sell-off was earlier, how steeply and sharply down that was. And then the recovery of the last 30 days is the third best in terms of steepness of recovery. There's only 2 other times in the last 10 years that the 30-period upslope has been steeper than it was. So you've got this combination of huge down and a huge up. In fact, this combination of down, and up, extraordinary volatility. So we're really in difficult times. The market kind of felt choppy in this period. These little cycles of the last 3 months have been really something to behold. And we're at the top of one of these cycles. You know, this is a natural place. It's harder for it to get steeper than this. And that's why you're going to see me framing some of these trades to the downside. And that's why I was willing to take profits near the swing highs on these swing trades during the week. I wanted to make bank on those because we still are only back at the 200-day moving average. We're still in an election year. We got lunatics running for office, and depending on which one wins, we're going to get a different brand of lunacy in our policies, and the market's going to be very volatile between here and October. So I wanted to make bank when I could. Having said that, there are some measured trades that I am putting on, but you're seeing me frame these trades in both directions. That's what I wanted to cover on that earlier. I forgot to. Okay, so that's Devon Energy. And where I am in Devon is had one trade in the bank. And remember, the dragon was down. It had been horrible. Here's the RLCO moment. That's pattern 1. This was the RLXD entry. There was the initial risk. Here was the positive trade for 5 days. And then took the second day and took it out and captured an R. And then it sold off and then held, closed nicely, opened up. I got it on Friday here at 23.60. My targets are 26.40, 29 even. This is my initial risk. I will probably move my stop up into here during the day if it starts moving in my favor. Yeah, Thomas, this is all part of that cycling the inventory. You got to buy them when they're in phase. You know, let me You're going to see this chart when it, in that curve briefing that I'm going to ask you to look at. But I'm essentially doing this, that the market itself moves in these kinds of cycles. And so that Bollinger Band mean in the middle, I try to buy them here and sell them either here or here. You know, this is like, I'm trying to buy this and either sell this or sell here, but I don't want it to come all the way back. Well, when the market does that, and if you're trading things that are in tune with the market, you're sort of responding to that condition. But at the same time, there are some things that start later and turn later. And so I'm always trying to get them near the bottom of that cycle and the hook up, and then sell just on the far side of the hill when it's running out of steam. So I'm trying to get that move. And I'm trying to protect against that kind of give back. I'm willing to give back a little, but not that whole move. Because I don't know that it's going to stop with a higher low. It might come all the way back to where it was, and then I'm out everything that I was up. That gives you some things to think about during the homework this weekend. Yeah, there's some surfing qualities to it. So what I want to say, how that curve idea works here is, here was that big slope down, and now it curved up and started to roll over. That's enough for me right there. What I'm highlighting is the piece of the curve that I want. But it didn't fail all the way down to this level. Instead, it rolled up. And so the fact that it didn't fail gives me this resumption. It gives me this higher low. And now I'm in from 2360, and now I think it's going to go to here like this. Or if I'm lucky, it could go all the way like this. And then I'd be looking to sell here or here, like little shower heads. So tomorrow, as soon as it starts going up, I'm going to move my stop from down here and get it locked into the money, no lose plus dinner for two, and then it becomes relatively easier on my psychology. So that's Devon Energy. Emerging markets. Well, yeah, Tom, I mean, it's the fact that it went down, I mean, it's keyed very nicely to oil. Oil cannot go to zero. I mean, the world runs on oil, for crying out loud. This is what that trade was like. It's been on this huge downward decline. We're going to see the same thing in Brazil. Brazil's been on a 2-year decline. So Devon did this, and then it didn't do that anymore. If it was going to keep going, it would keep going, but it didn't. Instead, it did this. And then it moved up far enough to meet some kind of criteria that said, you know what, the difference between that and this is enough that maybe it's going to do that. So as it starts moving up, as soon as I can move my risk to no lose, then I feel good. And what I'm really looking for is this trade from here to here. Yes, exactly. And remember, these cycles happen with market, sectors, and then target. With 50% of it being the market, 25% being the sector, and 25% being the target. In this case with Devon Energy, it's the energy sector and oil. And Devon just happens to be one of my favorite targets, right? So here's emerging markets. Now, emerging markets has been horrible too. Lest we forget, this is what the 2-year cycle in emerging markets looks like. I mean, surely we can't forget that. This thing used to be at 45, and it sold off from 45 down to 28. That's a 50%. 50% sell-off. And you can see the slope, the RL270, that's the fair value, the long-term fair value. But notice this. It no longer failed. If it was going to fail, it would have kept going down here, but it didn't. It gave us this much. So let's zoom in on that. Now suddenly, if I draw the chart this way, it doesn't look so bad anymore. In fact, let's remember what that RL270 does for us. It tells us what the long-term fair value of the long-term holders is. It's been down for 2 years. It's going to take more than this kind of a little move to convince them to change their mind in a big way, but you can already see it starting. The slope of that 270 is starting to flatten out. You can see that the 90, which is 3 times faster, instead of going down, it's already curling up. It's past the 6 o'clock position. It's already curling up. The 30 curled up and crossed the 90 and crossed the 270 and is now going up. So you can see how these things are starting to vote over time. Failure to fail further is information. So on the basis of that, we had a swing low, another swing low that was higher, and all we did was take this trade from here and made this trade, one and then back. So now we can zoom in on this a little more carefully. So this is a pattern for the lazy W and the RLXD entry here. Stop was down here. We get 1, 2, 3, 4, 5 days and out, and that was 2.2R in 6 days. Now, we take that exit there because coming back to the Bollinger Band mean or the RL270 is perfectly rational. Either one of these moves was a normal, not unusual move, and so we protected against all that. But what did it do? It didn't fail. It didn't fail down to here or to here, like it wouldn't have surprised us. Instead, it came over and started to go back up. So now here we are inside this day. It closed above the previous swing high. But it's already up at Z plus 2. Look how much higher it is. So on this basis, here's what I'm prepared to do on Monday. Here's my trade frame. And we've already made 2.2R on this, locked into the bank. I'm going to bracket Friday's price. I'm going to go long at the green line with the target to 35, the purple line. But if it fails, I'm going to go short with a target of below the dragon. If it fails below here, I'm going to add a second position, thus the second red. And then my target is the Bollinger Band mean. And if it fails below the Bollinger Band mean, I'm going to add a third position, and my target is the RL270. So if this is a place where the market is going to give everything back, the emerging markets have been bad for 2 years, that wouldn't surprise me at all. This is just a blip. This is going back to fair value. But I'm willing to invest one going this way. And if it fails, I'm ready to get short and then start pyramiding into the position to come back to the Bollinger Band mean and the RL270. So that's my emerging markets trade frame. And again, what I want to show is this trade from here to here is 2.2R, and then that's a counter trend trade, so there was no reason to hang around because my expectation is still that it's down because look at all this downward action. Of course it's horrible. So I don't believe in this trade. I'm just framing it. Okay. one of our frog champions. This is the same trade now in Mexico. We take the second entry, this RLXD. It didn't fail, so we buy it here with the stop just below the dragon, and we get a half an hour out of that one. And now it didn't fail. If it was going to fail, it would have come back to the 270. It didn't. Had a nice tight range on Friday and closed well. I'm going to buy the green line, and I'm going to sell the red line. And if it fails, my target is the Bollinger Band mean and the RL270. My target to the upside is 54.5. Brazil, this is the same trade, only we're still in this one. Brazil was even better than Latin America. If you add Mexico and Brazil together, you get Latin America ILF. But here's one. Look how bad Brazil has been. I mean, it's been horrible. It's gone from 55 to 18. It lost 70%. And it probably was, Robert. I'm sure it was. I mean, this Brazil trade is a washout pattern too. It was a washout pattern, but way back in here. But that's a hard one to believe in. But this one where it didn't fail below this swing low, at some point you got to say, hey, there's something to this. It's failing to fail further. So the actual trade we took, starting back here on end of February and 1st of March, is this failure to fail. The green is this green arrow here. And our initial risk was below this swing low. And so we're holding, this is almost 5R, maybe even 6R, because this orange line is is our risk. Yeah, this is our risk box right here. So let's see, 1, 2, 3, 4. This is about 5R. Either one of them, Robert. The washout frame is always going to be the first one, but it's the one you believe in the least. And after a while, the RLCO framework takes over, and then you can start getting continuation patterns using the pattern 1 through 7. Washout to get you started, RLCO to manage it routinely. So this is one where we got the entry. It didn't fail after these 3 days in a row up in here, and it's feeling pretty good. That sideways, it broke to the upside and closed well. This is really good. So last week we raised our stop to here. This week I'm going to raise my stop to that 1 day low. South Africa is one that just got added this week. It was a big gainer because of commodity price improvement. So I'm going to buy the green line. I'm going to sell the red line. My profit to the upside is this purple line. Target to the downside is this purple line. So I'm bracketing this trade in the usual way. That's a new one. Facebook. This is one we lost money on. 1R down. It came back. I'm still going to, I've got a new trade frame on. I will buy a breakout of the swing high, and we're going to get this if technology and the market rallies. So we'll get it at about 110, and I'm going to use about a $5 stop, and I'm just going to set that one up and go. China. You'll notice this. It's the same pattern every time. Here was the first trade. It pulled back. It didn't fail, so we get the continuation RLXD. We buy this, exit here. It failed to fail for 2 days, and it took off on Friday. I re-entered here at 32.50 with a stop at 31.75. It closed at 33. My upside targets are here, here, and here. I will go short if it fails below there, and then my target is down here. So just the usual pattern. Gold. Our entry was back here. Initial risk was here. Last week we raised our stop to here. It's still in place. We're just keeping it there. Just monitoring. Google's a new one. I'm bracketing this trade. Oh, I'm sorry. We got the entry on it. I had a sideways quiet channel breakout on this one, and we got the entry here on Friday, and my stop was here. This will be a stop in reverse if it fails. My target is the RL270, and so we're a little bit into this trade already. So we're long Google right now. Goldman Sachs. Finance has been beaten way down. This is that RL270 is the long-term fair value. Here was the double bottom. It didn't fail. We got the RLXD entry here with the risk right here. Went up 4 days, came back. We took the 2-day low, exiting here for maybe 0.2 or 3 R. It didn't fail further, and now I'm looking at this little 3-day recovery, and here is my trade frame going forward. I will go long at the green line, and I will go short at the red line. So I'm bracketing that one in either direction. The market's either going to get better or worse from here, and so I'm ready to go in either direction. The Russell small caps has been the worst of the 10 big indexes. Here was the RLXD entry. 11 days up, took the 2-day low out for 2R. It didn't fail further. It's holding at the RL270. I'm bracketing the 2-day trade frame like this. I will go long at the green line, short at the red line. My upside targets are 113 and 119. And you can see the downside targets here, here, and here. Just the usual stuff. U.S. real estate. This is the trend. Recognize this? Came up to Z plus 2, pulled back, we cashed. It didn't fail. So now I'm on Friday, it broke above the 2-day high. So I'm long from 75 with a stop at 74. I will go short at 74. I'll add a second position at 71. I will add a second position long at 78. That's my upside target right here, 77. So real estate has been immense, and it's a little uncorrelated from the equity markets. So if the equity markets get weak here, that can still do well. JP Morgan, I'm bracketing this one. This is a new trade. I'll go long at the green line, short at the red line. Coca-Cola. We're still in this one. This is one I've got to raise the stop on, though. We got this trade here with our initial risk down here. It mucked around, and now instead of coming back, it took off, so now it's up at Z plus 2. So now I'm about almost an R into it. I need to move my stop up to a 2-day low. I'm going to raise my stop to there. Low is one of my old reliables. It gave me an RLXD entry here on Monday from a trade frame. There was my initial stop. There was my entry. We're still looking good. This is my target at 75, just monitoring and managing that stop. McDonald's, hooray. This was dead money for the long while. We got the entry here with our risk down here, and finally took off at the end of the week. I'm going to move my stop up to Friday's low at 120. My first target was 123, then 125. No reason, Gil. It's just you got to trade something. TNA works just fine. So does the Russell 2000 futures contract. IWM is just the baseline. It's just as easy to see that as it is to see it anywhere else. All comes down to how much risk you want to take. Microsoft is still kind of semi-dead money. It's in the money, but still less than 1 hour. Got our entry on this day here with a risk down here. So that was our entry and our initial risk, and now we're about half an hour into it, maybe. Profit target is still up here. I'm going to move my stop up into just below the dragon tomorrow. Actually, Gil, the reason you got to answer your own question. You decide which one you want to use. You should not worry about why I use one or the other. The pattern is going to be exactly the same. The reason I use IWM for this one is because when I'm trading this with the futures contract, it takes its numbers off of the off of IWM. The numbers are identical. So this is TNA. This is exactly the same pattern. It has to be mathematically as the IWM trade. There's exactly no difference to it. Well, cheap is irrelevant. It is how much you risk per trade, the dollars per share, and then the amount of risk that you take. It's cheaper. Doesn't have anything to do with anything. Everything is risk reward and percentage of portfolio at risk. Let's see, Nike. Nike is pretty much dead money, although it's in a good position right now from one of the patterns. It was a 551W, I believe. So we're still into it long from here. Our risk was down here. So we're just barely in the money right now. This is one where if I was smarter or sharper, I could have gotten this exit here. But as it is, I'm still into it. This is still my target to the upside. I'm hoping the fact that it has a higher low is going to help me out. So we'll see how that shakes out. Procter & Gamble. This one has to fish or cut bait tomorrow. We're long from here. Risk was here. It's just been mucking around. The RL10 has rolled over. It's really got to turn and go. Otherwise, I'm cashing that one tomorrow. Just a quick look at the S&P. The S&P is looking to be in great shape. I don't have a trade on it per se, but that's even stronger than the Russell 2000. That pullback was less, and it's already 3 days into recovery. So I feel pretty good about the market. Notice that everything is now on the correct side of the RL270. Everything is pointing north of that now. So that's why we're pretty close to getting back into the bull. Tesla, I'm going to raise the stop on this one again. So we got the RLXD here at the turning point of the dragon. Our risk was down here. Our entry was here. We've got this trade in hand. Last week we moved our stop to here. It held all week. I'm probably going to nudge it up just a little bit further. I'd like to see it get through the 270 and go. So let's see it do that. Go Tesla. United Health, this is a good news story. It finally, you may recall this from the very first set of trade frames we did. I said way back in the day that if it could get above this 124, then off it could go, because it will be leaving all of this crap behind. So all of this stuff just got negated, to borrow Robert's phrase. All of that was negated by this price action here, and this thing could just really, really go. And what I like about this is that healthcare had been dominant for 2 and 3 years ago, but last year suffered. So here's United Health finally coming out of the shadow of Obamacare, and this thing could really go. And we got a nice entry on it from way back here. So I'm looking to pyramid on this one longer term. I really, really like that. Urban Outfitters, this was another one of those horrible downward slide and then a great big rebound. This is one where I will go short at 32.40. I will go long at 33.60. I'm going to bracket it and do this. My target to the downside is the Bollinger Band mean. To the upside is kind of unlimited. So I like the fact that it didn't fail for 4 days in a row after this great big gap. Oil did not fail. That's good. Remember, oil had been suffering, and it failed to fail further. So we got our RLXT entry. We cashed this one. It did not fail. I'm now going to bracket this. I'm going to get long at 10.50 with a dollar stop. So there's still room and energy to go. I like that we cashed this winning trade here for about 1.2R. VIX is nice. We've been short that for a while. We initially got short here at 25. It took out our target. We put a second position on here. Both of those are in the money. I'm looking for it to come down to 19. That could be a big win. Verizon has been one of the 3 strongest in the Dow for a while. This was our trade frame. This was the day we got the entry. This was our stop. We last week raised our stop to here. It did not fail. I'm going to look at raising my stop up to just below the dragon to lock in no lose plus dinner for 2. Walmart. We got our entry here, cashed our exit here. I have no trade frame on it. It looks like dead money to me, and there are other ones that I want to see first. Win has been a prime intraday as well as swing trade candidate. We got our nice entry here at 68. We cashed at 84. It didn't fail back. In fact, it gave us a 1, 2, 3 entry on Friday, So we're back in at 86, target 102. I will stop and reverse at 80. Let's see, I think XME, yeah. Felt like we were late to the party in XME, but we took it anyway. We cashed this trade for 1.3. It did not fail, and so we're back into it here at 19 even and are in the money. If it gets above 2050, I'm looking to add a second position. I'm going to manage that one very closely tomorrow. And that's everything. So that's about an hour's worth of hard work and managing the trade frames and setting up the, that's the preparation for those trades going forward. So the span of control on swing trades, I'm just showing you about 20 right there. That's manageable if you get those. You got to put those orders in, and they're basically mechanical, and then you can put warnings on them so as you're getting close. If you want to micromanage the 2-hour battle drill, you can. But it takes some management, but it can be done. You can do it with end-of-day data and manage it, in half an hour a night, if that's what you want to do. So there we are. That's everything I wanted to cover on the swing trades. And you have your homework, and I owe you the RLCO framework, the build. I will narrate that one tomorrow, and off we go. So we're about 2 hours into it, so take good care. And I got to go walk the dogs and get some air, and then it's back to work. Oh, I do, Robert. I listen to myself all the time. I rehearse this one time, and then I give it, and then I can hear it as I'm giving it. So, and I'm taking notes. So, appreciate it. You guys take good care. We'll see you in the chat room.